Good morning, Insignio family. Today's February 5th. My name's Alejandro Guardiola. I'm going to be your host today. With us, we've got a very special guest. We've got David Gross, head of acquisitions and part of a very strong real estate team at Morgan Stanley. David, welcome to the show.
Thank you for having me. I really appreciate the time and this opportunity to tell you about the fund.
Amazing. So when we're looking at some of the newest things on the shelf for Insignio to be able to access for clients, this one fits squarely in recently launched. Can you tell us a little bit about what you're doing at Morgan Stanley and a little bit about the North Haven Fund?
Yeah, absolutely. So North Haven Net REIT is Morgan Stanley's real estate private equity division's newest fund. And what excites me the most about this fund is the vintage and the entry point. So when you think about what's happened in the broader capital markets over the last couple of years, stocks are up 100% or whatever it is over the last 2 years. Real estate is off 25 to 30%, right? And has not recovered. So when you are thinking about deploying fresh capital into real estate, you're buying at everything looks like it's on sale. We're buying phenomenal, safe, income-producing properties at cap rates that would have been unheard of 2 to 3 years ago. And as background, the team that's managing this fund, North Haven Net REIT, is a 200-person global team that manages about $50 billion of institutional real estate. Institutional capital that's invested in real estate. And that same team is now bringing all that expertise to launch and to manage North Haven Net REIT in a differentiated strategy. Those other vehicles that we manage are diversified real estate private equity funds. This is focused squarely on triple net leases. And triple net leases are a subset of real estate where a tenant bears all the responsibility for taxes, insurance, and repairs and maintenance.
Is it fair to say that as far as a gateway entry point for clients looking at private markets broadly, this is on the safer side of things, all things considered?
Yeah, this is, in my opinion, the safest place to play real estate, because in all of our deals, what you have is a long-term creditworthy lease with a tenant at a fixed and escalating yield. And so you have very consistent, safe cash flows, and you know what your cash flow profile is going to be. And you don't take any inflation risk, right? So in a typical residential deal, for example, if your taxes get reassessed, or residential in Miami, for instance, insurance has been a major issue. It's gone up twice, 3 times over the last few years. That all hits your bottom line. It compresses your margins. But in the triple net lease structure, and we own one property in Florida, in Panama City, as an example. When it's an industrial building leased to an investment grade tenant for 10 years. When insurance doubled there, like, the tenant pays it. So we still earn our yield with no interruption, no compression to our margin.
Is the building okay after all the snow that we had a couple of weeks ago?
It's fine. Yeah, that was definitely something we had some not unexpected, but it survived.
It's the market, right? It's like unexpected. You mentioned the inflation protection nature of it. So these escalators. Yeah. What's the average escalation in rent per year?
Yeah. So our current portfolio, the economics of our current portfolio, our average cap rate is 7.3%, with roughly a 2.1 or just above 2% escalator. And when you think about what that means is every year our 7.3% goes up 2.1% in terms of the yield that we can deliver. But we're planning to run the portfolio with 55 to 60% leverage. So that 2.1, just to use rough math, double it, right, is the experience of the inflation protection. But the other piece of the inflation protection is all the operating expense protection you get under the triple net lease structure. So if payroll goes up, repairs and maintenance goes up, insurance goes up, taxes go up, we don't see any of that operating expense erosion to our margin, because the tenant pays all that.
Sure. Kind of reframing the perception issue. Some folks might think while office was an awful place to be,
Yeah.
I hope that this is not an office fund. Compare and contrast what pools you guys are playing in versus the, media.
Yeah,
headline.
so we don't have any office investments. We're not playing in that office at all. The
Okay.
three sectors we're spending the most time on are industrial,
Mhm.
which includes distribution centers, which are a derivative of e-commerce, driven trends. So we're very excited about distribution centers, cold storage.
Mhm.
Cold storage is a form of refrigerated warehouse that supplies grocery stores with food, and then manufacturing. So as manufacturing gets brought back to the U.S., we think there's going to be a ton of tailwinds in that sector as well. So distribution centers, cold storage, manufacturing, as well as healthcare, medical office buildings, laboratory, pharmaceutical buildings. The aging demographics in this country will continue to drive the demand for healthcare real estate
Sure.
and certain forms of essential retail as well. Retail was everyone was extremely concerned about it about 10 years ago when Amazon started to make a massive push. But what I think we've all realized since then is that there's still a place for certain types of retail that can't be disintermediated by e-commerce.
Absolutely. Yeah. You got to go physically to doctor's offices.
That's
You
right.
got to take your pets physically to locations we can. It's not all, metaverse, hypothetical, virtual
Yeah.
world.
Exactly.
Yeah.
Exactly. So we are not playing office. I think the office sector has got
A bad rap.
yeah, look, rightfully so. Class A office is going to be fine.
Sure.
And if you could buy Class A office at exceptional values with a long-term lease, we would do it. And we're actually looking at a couple deals now where we get what we think is a screaming value, where we're going to get all our money back through the lease and get the office building for free. But
Okay.
only Class A office. Class B commodity office, we're not going to touch. And we haven't done any of it yet. So we've done 20 deals over the last 9 months. We launched 9 months ago. Everything we bought is brand new in terms of the market valuation. We don't have any legacy assets that could have a valuation overhang.
Correct.
And so far, no office.
To your point about the vintage and entry points. This is
Exactly.
fresh,
Exactly.
freshly minted.
You don't need to worry that we assembled a portfolio at the peak and are we marked appropriately.
Mhm.
Everything is bought in today at today's values. And that's how you're able to get a 7.3% cap rate, which all these deals, we can go through them in more detail because I led all these investments, would have been 5.5,
Yeah.
5s at the peak.
Sure.
Yeah.
750 million in investor money. That's committed. Have you guys?
So it's an evergreen structure.
Sure.
With a monthly cash flow is drawn monthly and liquidity is offered quarterly.
Mhm.
We've raised about 750 million, and that's all been drawn into the fund. Our portfolio is $842 million. So all the money we've raised is working, but we are under levered right now. And in 2025, because we're a relatively new fund, what the plan is to lever up our assets and ramp the leverage in the portfolio. So right now, the fund is delivering a 6% dividend yield,
Okay.
and which is our target. So we're already at our 6, but the total return target for the fund is 10%.
Okay.
And that will be achieved in 25 as we lever up the portfolio.
Explain to us then, how do you guys achieve the leverage? Is it using Morgan Stanley's balance sheet or?
Yeah. So we are religious about no conflicts of interest. So the answer is no. We won't borrow from Morgan Stanley. We won't do deals with our other funds. We won't joint venture with other pieces of Morgan Stanley. This is like, there's no, we don't want to be even the perception of a conflict of interest. So all the leverage is either third-party lenders, other banks who are providing mortgages,
Okay.
and eventually we'll have some fund level unsecured leverage as well. But right now, everything we're doing is at the property level, secured at the property.
Let's take a look under the hood as far as geographies and
the assets. So with our geographies, it's pretty diverse. We're spread out all over the country. In terms of asset class, the portfolio we've assembled to date is overweight to industrial cold storage and manufacturing, which I all consider part of the industrial sector. They have a little bit of exposure to healthcare and to retail. And the average tenant credit rating is triple B minus, which is just above the investment grade level. The weighted average lease term is 14 years. And as we said, the cap rate is 7.3 with about a 2% escalator. But when you go even deeper into the weeds here, the tenants we have, which include Amazon, Tesla, FedEx, like brand name household names. But more importantly, in my opinion, phenomenal pieces of real estate at great bases. This is not just an Amazon facility that is not leasable to someone else in a tertiary location at a high basis. This is a phenomenal Amazon last mile distribution facility in the wealthiest submarket of Detroit, for example. Or we own buildings at the Port of Virginia. We own buildings in Boston, right? So these are great real estate investments with great bases and investment grade tenants attached to them.
Sure. At the heart of it, you guys are doing credit analysis on the tenants, as well as having a deep bench for the real estate portfolio.
Yeah. So the fund is launched within the 200-person real estate team, but my partner and co-PM of the portfolio is Hank D'Alessandro. Hank started Morgan Stanley's private credit business, and he used to run leverage finance for the bank. And so we have a credit team led by Hank who is underwriting the credit of every tenant. But if you were to ask me, like, what is the biggest mistake people make when they do net lease? It's that they think of this as a pure credit product and not a real estate product with a credit underwriting attached to it. Because, I'll give you an example.
Not the other way around.
Well,
they fall in love with a piece of property and then try to fit the credit to match the property and get it that way.
It's the opposite. It's all of our competitors fall in love with the credits, and then they overlook the real estate attributes of what they're buying. And that's because almost all of our competitors, what they have is a private credit team dressed up as a triple net lease real estate investing team. And so if I were to say to you, like, I'm going to lend money to Amazon and I'm going to get the Amazon credit, would you rather the Amazon credit backstop your interest payments or your principal payment? Right? In net lease, if you were to extrapolate it, the real estate is your principal. The lease term and the rent you achieve is your interest payment. And so that's why I think the way we're playing it, where you're hyper focused on the real estate attributes and you're doing this within the confines of a long and tenured track record real estate investing platform, is the right way to play this over the very long term. We are comfortable taking back any of our buildings vacant at the end of the lease if we needed to, because we are doing the real estate work up front.
Right.
The credit is all there also. I mean, it's a triple B, it's an investment grade portfolio, but it's, to me, that as a real estate guy, that's like, that's the secondary aspect of it.
It's in sharp contrast to some of the other competitors. And I would say that full stop, because it is, because they actually,
So the way our competitors who are credit first play the space, if you get into their business plans, the way they play the space is they flip the assets 2, 3, 4 years after they buy it, no matter what. And that works if interest rates are coming down.
Correct.
If interest rates are up and cap rates are up, they got to hold it. And then as you get closer to the lease expiration, you better love the real estate you bought.
Mm-hmm.
Yep.
So that's the main difference between us and our competitors. There's a few other differences, but that's our angle on the sector.
Okay. What should we expect as total number of holdings? What's the average check size? Give us a little composition of what we'd expect.
Sure. So our portfolio today, which is about $840 million and 20 properties, would imply an average deal size of around $40 million a pop, which, at our current scale, it feels like the right amount of diversification. One of the challenges we have is we want to deliver phenomenal real estate investments. We also need to deliver diversification. So I can't go do a $5 billion data center deal and put all of our investor money in one property. So I think $40 million is a nice average size.
Yep.
As we ramp and scale the portfolio higher, maybe that increases a bit.
Yep.
But I think a good good guidance for investors are we'll continue to buy real estate at around a 7%,
Sure.
high sixes, a low sevens, blending to around the 7.3 that we're at. But crucially, we are going to be buying the best real estate we can at attractive bases. So, for example, in our portfolio today, our average discount to replacement cost is about 25 to 30%. So when you buy real estate, Class A real estate below the cost to replace it, you're setting yourself up for potential appreciation in the future.
Absolutely. To maintain the 6% fixed dividend yield of which it's paid out monthly, so 0.5% every month, that's nice, that's smooth. We're not dipping into NAV to fund distributions by any
Right.
stretch.
So the goal is obviously to cover your dividend, right? And
Correct.
so right now we are paying 6% and it's fully covered.
Right.
And we're not even fully levered. So there is upside there, but we don't want to overpromise. And the way you get there is if you think about a 7.3% unlevered return, then you add some positive leverage to that. Right. And then we need to hold a portion of the portfolio in liquid assets so that we can meet redemption requests if we ever needed that. That's dilutive to that 7.3.
Sure.
That's how you end up around 6.
What percentage of the fund would be in, liquid market?
We think it's probably around 15%, maybe 20%. Between 10 and 20% is the answer. And it's not going to be invested in the stock market, right? It's not risk on assets. These are going to be money market. This is really as a liquidity tool. So
cash alternatives.
Alternatives. Yeah.
Okay.
Yeah.
All right.
We're going to have a small piece of the portfolio. We have one investment right now in real estate debt, for example.
Okay.
So to the extent that in this period of dislocation in the real estate markets, you can find debt opportunities that provide, in rare cases, but they exist, returns commensurate with equity or higher. We'll do that. And we'll do 10% of the portfolio in real estate debt. So we actually have another Florida investment. We lent money. So of the 20 investments, one is a real estate debt investment. It is a senior housing, again, in the healthcare sector, a sector that we love, senior housing property in Naples, Florida, that we lent a mortgage between 0 and 70% LTV. And then we took back leverage on it and kept the 50 to 70% portion. We have a spread in the low 800s over SOFR for that. So we're going to earn 13%.
4.36 plus.
Yeah, plus some fees in and out. We're going to get a 13% higher earn that deal, let's say, for a very insulated, right, with 30% equity behind us. So when we see something like that, we'll be opportunistic. We'll jump in and do it, but that'll be limited to about 10% of the portfolio.
Senior housing, not to be confused with senior portion of the loan that you gave this business.
This is a senior housing property, and then we gave a senior loan, but we got back leverage where we basically kept the mezzanine portion.
Okay.
So that's the type of that is separate from the liquidity that keeping in cash alternatives. We'll have a small portion of the portfolio in very attractive real estate debt opportunities, but the vast majority, the other 19 deals in our portfolio are long-term triple net leased properties.
I think it's, just given the peer group and the other type of companies that are involved in this space, but there's been a big focus on data centers, things like that. And we talked a little bit about how we differentiate ourselves from that. And maybe we talk about the Lifetime Fitness deal and a few of these others that wouldn't usually see in a portfolio like this and why it's exactly the type of deals we're known for.
Yeah. So I'll give you a couple examples of specific deals in our portfolio about how we source them, why we think they're phenomenal values. We have 2 sourcing advantages. The first is when you have a 200-person real estate team, we've got unparalleled real estate relationships, and we're seeing off-market deal flow. And so, for example, and I'll get to the Lifetime example in a second, we've got a case study in this book of a last mile Amazon distribution facility that we bought at a 6.5% cap rate with 3.5% escalations and on a 10-year lease. I've looked at every Amazon facility that I could find over the last couple of years. They trade in the 5s.
Right.
So the way we were able to generate 75 basis points of upfront alpha on this deal is we have a relationship with the developer of this building. They built the building speculatively with no tenant. They leased it to Amazon, competed with 3 other tenants. As they were signing the lease, we said to them, hey, you've been trying to get into business with us for a long time. We got this new fund. Why don't we make this our first deal? We'll buy it from you. And we were able to get a sweetheart deal. So the real estate angle is one of our sourcing advantages. The other is being part of Morgan Stanley. When you think about what a triple net lease is or a corporate sale leaseback, it's an alternative financing mechanism. And the decision is often made at the CFO level. And when they're thinking about how to capitalize their business, one of the first calls is to their investment bankers. And so I'm in constant dialogue with our investment bankers about corporate clients of the firm and how we could offer our sale leaseback as a solution. Lifetime Fitness is a big client of Morgan Stanley. We took them public. We are a lender to them. So it was a very easy call for us to call the CEO of Lifetime and say, hey, we got this new product. Morgan Stanley wants to expand the relationship with you. Why don't we do a sale leaseback on your facility in Gilbert, Arizona? This is a phenomenal piece of real estate. It's 12 acres, great demographics, right in the middle of Phoenix. And we got a 25-year sale leaseback with them at a 7.4% cap rate. There's escalations in the lease. So delivering a 7.4 off market cap rate on a 25-year lease. But importantly, again, this is real estate the land is going to be worth more than this building. It's already almost worth the same amount, just the vacant land because of its location. That was front and center for me.
Incredible.
Another example of the types of analysis we're doing, we bought a Class A warehouse or manufacturing facility leased to Oceaneering. This was actually the first investment that we did. It was a 14-year lease. Oceaneering is a public company, couple $1 billion market cap. They do defense contracting for the U.S. Navy, and they're one of 3 companies that are able to service the U.S. Navy submarines and repair them. And in this building, right at the Port of Virginia, we bought a Class A building, leased them for 14 years, 7.75% cap rate, 2% escalations. This company borrows money if you bought their bonds at around 6%. So we're getting 175 basis points of spread to their bonds. Then our yield grows 2% a year. Plus we have upside because we own great real estate there. And they need to be there because they are servicing the U.S. Navy in that building. They can't leave. So when you think about our position relative to the bonds, not only are we getting a yield premium, but our position, I think, is senior in the capital stack to this company's bonds because the lenders to this company would never terminate our lease because then they don't have a business anymore.
Correct.
So that's the analysis, and we've repeated that.
Mission critical.
Yeah, exactly. We repeated that business over and over again, that business plan over and over again in our portfolio. Some of them, like the Amazon facility, you can't argue that's mission critical. They have 1 million warehouses, but it's a phenomenal real estate deal.
Sure.
Some of them are mission critical. Some of them are great, just a great investment like the Lifetime deal.
Yeah. So you can go on for days talking about
I go through all 20.
Yeah, we literally could. So we're coming up on the on our allocated time. For those who were not familiar with the fund, let's talk about the terms, the minimums, and the subscription process, how we would access the fund.
Sure. It's through the iCapital. So it's offshore, offered through the iCapital feeder. And it's monthly subscription, $10,000 minimums.
Wow.
And quarterly liquidity.
$10,000 minimum.
Yeah.
Okay. This is offshore friendly, domestic friendly.
Not domestic friendly yet for you guys, offshore friendly, up and running. Yeah, we have an offshore agreement to get this up and running.
Okay. Brokerage and advisory share classes.
Correct.
Wonderful. Okay. Amazing.
Okay.
Thank
great.
you.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignio.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://